edition of On the Move with your hosts, Chris Blasi and Richard Checkan. As you know, we have these periodic market updates, and tonight is really going to be an exciting show for those who've been following the precious metals markets. What's transpired since we last spoke has been not only something that was forecasted and basically we've seen coming, but it's actually doing it in a way that's even more robust and more exciting than we were expecting. So just to start off, I want to introduce you again to my co-host, Richard Checkan. Richard is the president of Asset Strategies International, a role that he's held for over 15, 20 years. You know, Richard's background is as an officer in the United States military, and he's also been a graduate of West Point. So Richard is quite a distinguished person from many different angles. Richard, great to be with you tonight.
Great to be with you as always, Chris. And I know everybody knows you after how many of these we've done at this point, but just a quick introduction of you. Chris Blasi is got about 30 years experience in the industry or more, over 30 years. Worked in brokerage and boutique operations as a broker dealer in the financial services sector. He also marries that with a lot of experience in, technology, and specifically as it pertains to the financial services industries. In 2005, Chris started Neptune Global, and he's built a full array of precious metals trading, storage, custody, operations. But the one thing that caught our eye, and that's why we're talking today and why we've developed such a good partnership, is he patented in 2013, I believe it was, the PMC ounce, which is a fantastic product. It's a 4-metal composite, allows you instant diversification in buying precious metals, and it's something that we've been offering to our clients ever since we met him and found out about it. He's been quoted on every publication you can think of, and all the household names. He's been on it, and they're glad to have him because of his expertise. Chris, tonight we have a wonderful guest. You and I both known Brien for a long, long time. Brien Lundin, he's the CEO of Jefferson Financial Companies, or Jefferson Financial Incorporated. He's most known for the fantastic continuation of Gold newsletter and the New Orleans Investment Conference. Both are standards in the hard money industry, started by James U. Blanchard III, as you know, and Brian's done an amazing job with both of those entities over, how do you say it, Brian, spanning over 4 decades at this point. It's my great honor to have Brien with us tonight, and the insights he's going to share are going to be absolutely worthwhile. So welcome, Brien.
Great to be with you, Rich and Chris.
All right. So apparently, as Chris alluded to, there's a little bit going on in the precious metals market over the past month or two, and I would argue it's been going on much, much longer than that. We've talked about this, written about it for a long time, that there's been incredible consolidation just below 1350 in a fairly narrow range going back about 3 to 5 years at this point. And that was significant resistance on the way down from the all-time highs at 1900 in 2011, and there's really wasn't much resistance from 1900 all the way down to about 1400. So it makes sense that there would be significant support now turning into resistance as we broke through it over the past few weeks. But it took a long time to consolidate and get up there. I'm going to start off with you, Brien, and kind of throw this your way. We had a number of attendees, registrants that came in and offered questions ahead of time. And the number one topic on everybody's mind is, we've seen failed attempts before. Why should we believe, or is this one to believe in, that we've actually broken out of this range and are in a new bull market? What are your thoughts?
Well, I think this one does have legs. I think this is not a false breakout. And I guess you can look at it from 2 standpoints, both technically and fundamentally. Technically, as you mentioned, as you alluded to, once we got over $1,400, there's very little resistance between these levels and say $1,900. And that, of course, has to do with the way that gold declined from those levels in almost a waterfall fashion. So it barely paused along the way. I think there's one little level around 1525 that some people are looking at as being a little bit of resistance because it was a little bit of support on the way down. But other than that, there's lots of running room for gold from these levels from a technical standpoint. And that's also important because that brings in a lot of these generalist trend following traders who really have no connection with gold, have not been watching it so closely as we have over the past 4 or 5 years, and haven't really been hurt by it like we have. So they're not as cynical. They're just watching the charts. They're seeing a breakout and they're bringing the money into the sector. And that, of course, is perpetuating and even accelerating the rise. The fundamental reason, though, is what really has me excited. There's a real reason behind this rise, and it's not trade tensions with China. It's not geopolitical hotspots here or there. It's the kind of fundamental monetary factor that always has to be actually behind any kind of a long-term secular bull run in gold. And of course, that's a return to easing from central banks around the world. And they really have no choice. Whatever economic growth has been engendered since the 2008 credit crisis has come due to this massive liquidity that the central banks have provided over the last decade. And interest rates at literally 5,000-year lows, something we've never seen before. So once you create economic growth, create this kind of growth through the adrenaline of easy money, then the patient continually requires a greater dose to get the same effect. And that's the trick box that they're in. A corollary to that is the fact that these low interest rates have encouraged massive debt creation. And debts are now so large, particularly in the US, but really in every developed country. They're so large at this point that we can't have anything approaching normal interest rates again, because we just can't afford the debt service costs at these higher interest rates. So we're going to have low and falling interest rates for, frankly, forever until there's some kind of a monetary reset. And this is tremendously bullish for gold, for silver, for a lot of other things as well. But gold and silver are the primary ways to play this, as they have been for thousands of years.
Gotcha. What about you, Chris? Is this for real?
Sure. So, for over a decade, there's been the fundamentals that have been supporting the rise of gold, which, this secular bull market really kicked off in 2002. And we're hearing this, speaking with our customers on the phone each day. The point they're missing, they're saying, is this a false rally, right? But the previous 4 or 5 years, it was gold rallying to 1350 and getting knocked down. Breaking through 1350, and decisively breaking through, cutting and immediately going to 1400 and breaching 1400. What people have to put in perspective is, no, that it's already proven itself. That resistance is broken. So it is that just on itself, just alone, is proof positive that this isn't what we experienced for the previous 4 to 5 years. And now, I think you see, because as Brien pointed out, and on a technical perspective, there's very little resistance from between here and 1700. And it is performing admirably. It is, what we saw this week was tremendous. And we saw some people think there's a correlation between the stock market and gold. Well, when the stock market got crushed earlier in the week, gold was up. The next day, when the stock market had a bounce back, gold continued to go up. It does its own thing. Don't look for the stock market for your cues. And there's so many aspects, there's so many things of what are the drivers for gold. But just to build on like something Brien pointed out, the interest rates, you're going into negative interest rates across Europe. We're going to zero interest rates. So even the whole idea that the cost of carrying gold, versus what you can earn somewhere else. The Swiss have introduced a 30-year bond at negative interest rates. It's insane that you would give someone money theoretically to hold for 30 years and they're going to give you less back. Does anyone think gold will be lower 30 years from now? not going to happen. So it is just the options for preserving and protecting your wealth are just disappearing, and it's really going to come down to predominantly gold and silver.
I agree with you both, and I want to get a little further into this currency reset in a second, but just a couple thoughts. You know, we talked a little bit before we went live with the broadcast, and you know, we're still at this point in this range seeing what we call tired liquidation, and this is something Chris and I were talking about. You know, that's where people had bought at a higher price. They watched it run down. They saw it fail the attempts to get through resistance, et cetera, and they just got completely frustrated, but they didn't want to sell it at a loss. And eventually it gets, at different levels, it gets to a high enough point where an individual says, okay, throw in the towel, I'm going to go ahead and cut my losses and sell it here. I've loved a quote a good longtime industry friend shared with me when I first started about 25 years ago. He said, if you buy gold for the right reasons, there's no such thing as the wrong price or the wrong time. Okay, this is wealth insurance. It does its job. It does its job at $1,900 an ounce. It does its job at $1,050 an ounce, like the recent lows in December 2015. It still preserves purchasing power. That's what it does. And but I know where the clients are coming from. They buy it for wealth insurance, but nobody wants to see any asset fall in value. It's hard to keep the emotions out of the game at that point, and that's why sentiment was so low down at those levels, and why it had so many failed attempts to break through. Unfortunately, we have people selling at the wrong time. They should be buying here. You know, I think we all know this. And when they start buying, it's going to be late in that rally, and they're going to be right for buying. Eventually, they're going to get up and above those prices too, but do they have the stomach to wait for it? So it's all understandable, but you know, I'm a believer in this one. This is for real this time. There's no question. And when I say this time, I mean in the short view. In the long view, there's never a bad time to own gold.
You know, Rich.
What about silver? And I don't want to go ahead and answer.
Yeah.
Say what you're gonna say.
I was just going to say that if you're looking at it as wealth preservation and insurance, which everybody should look at physical metals as, if you look at your homeowner's insurance and you see that, darn, the price went down, I could have gotten a lower rate with this other agency or this other policy, do you then cancel your homeowner's insurance and go without insurance at all? And that's really the question. I have a bag of junk silver that I bought at $30 an ounce, and I'm glad I have it. You know, I wish I would have bought it cheaper, but it's not like I'm going to try and sell that as a profit. That's insurance against some sort of financial calamity for my family, and it really doesn't matter to me what price I bought it at. What matters to me is that I have it.
100%.
And I just have to add, because this is a lot of what you're talking about, it's not just about precious metals. The same psychological hindrances are plague investors in everything, right? And the problem is, you know, people will say, you know, if the market's really moved on fundamentals and not emotion, the stock market wouldn't be, the S&P wouldn't be where it is. Fundamentally, it's so overbought.
Y'all hear me?
Yeah, I got kicked off.
Okay, I was wondering, you froze up on the screen there and then I didn't hear anything. Pick up where you left off. I think we're all here.
So where did I leave off, though? I don't know where I lost you guys. So the point is, so the investors buy the metals, they bought it for the right reasons. The fundamentals support it. The fundamentals haven't changed. But what, unfortunately, if they don't realize those gains right away, and I get it, you know, it's supposed to be just wealth preservation insurance, but if they don't get those gains quickly and there's a protracted period of time where they just see it trending sideways, they feel like they made a mistake. And then it goes down a little and then it comes up and then they just get even and they cash out. And they forget that they bought it for the right reasons. It doesn't mean, well, because you were right, it was going to do what you expected to do the next day or the next week or the next month. But now it is performing based on the fundamentals that are the drivers. And unfortunately, a lot of people are going to cash out now because they're just even, and it's going to be hundreds of dollars higher in the next couple of years. It is going into the third leg of this bull market. I mean, I'm a strong believer that this is a secular bull market. And if you look at the chart, it's moving in a classic fashion. It started in 2002. That first leg went from around 275 an ounce to that 1900. It did a classic 50% retracement, bottoming in December of 2016. And yes, it actually has been in a bull market since 2016. It did trade sideways for a number of those years, but it's been in that third leg. And that third leg of a secular bull market is always the most robust and the biggest gains are made. And I just think we're picking up steam again in this third leg. And the really big gains for gold are coming in the years ahead. There's no doubt about it. Now, you know, now it's behaving the way the fundamentals and kind of the craziness in the world and the financial markets said it should behave. But it doesn't mean there aren't periods of time that, despite the fundamentals, it's not going to perform the way you want. But for those who sat tight, don't lose faith. And, you know, and I don't mean to say it because I'm a PM dealer, but if anything, you shouldn't be cashing out. You should be kind of adding to that position right now because it's kind of proven itself. And with this breakout over the last several weeks and how it's performing and staying solidly above 1400, you probably concur with me that it's kind of proven itself. The fundamentals are there, and now it's proving itself even on the technicals that this is for real.
Before we move on to the reason that I think we all believe that what you just said is going to come to fruition, kind of the second leg of what we want to cover here tonight. I just want to touch real quickly on silver. Silver's been lagging gold. You know, I have some thoughts on that, but what are your guys' thoughts? It looks like silver above 17 bucks an ounce. It's broken out as well. What are your thoughts on the future there?
Well, my view is that, well, first off, getting back to the confirmation of gold, I think silver had been lagging, and that was the thing that was worrying me. If you look at a secular bull market in gold, you want three factors. You want gold moving, you want the mining stocks offering leverage, and you want silver offering leverage. In other words, outperforming gold, which is its role, which is what it usually does, almost always does, in fact, in a bull market or a trend that's driven by monetary factors. So I was kind of worried because gold was moving, the mining stocks were offering leverage, but silver was stuck in the mud up until, what, 2 or 3 weeks ago. And then silver broke out and started really dramatically outperforming gold. I mean, even on some days when gold was down a few dollars, silver was up as much as 1%. So it was really a dramatic outperformance. So that is yet another confirming factor for me. And an important one. And I love silver here. I think silver is going to continue to offer leverage to gold. And I always tell people, if you like gold, you have to love silver. And, you know, all of the metals perform differently, but silver is one of the things. And I would not put all of my money in silver or all in gold or all in anything. I think you need a diversified approach, but you do need to have a healthy allocation to silver.
Chris?
Well, I agree. I mean, silver generally will lag gold's rise, but it confirmed, just like Brien pointed out, waiting for that confirmation. Is silver going to climb on board? And it is now. And like it characteristically does, right? It's more volatile than gold. And that's not just to the downside, but to the upside. So now its gains are of a greater magnitude than gold. So again, it's very comforting from someone who's looking for all these confirmations, whether it's technical, how the behavior, I think you guys might agree, everything's falling into place the way we expect it. You know, and that, I guess, is also should give a comfort level that this isn't a false rally or a false start. Because in some of those other rallies, all the confirmations weren't coming in. You know, maybe gold would have a good little run, but there was other things that just weren't supporting it and were missing. And now they're all in place. So this is why I think we can all say it looks comforting. I mean, you know, and gold also moved up a little bit prior because, you know, some of those big international buyers, right? The Central Bank of China and Russia. Don't forget, they buy gold, they don't buy silver, right? And so that's getting accumulated first, and now it's trickling down, and now silver's coming up. So, of course, I think we'd all agree the upside potential in silver is tremendous, but don't be chasing one, right? Don't take all your money and say, well, then I'm just going to take silver because it's going to outdo gold. There's a logic and a way to have a less volatile portfolio by having that diversification. So just take your positions logically and don't overweight anything. Yeah, will silver outperform gold at the end of this rally years from now? Probably, but it'll just be, believe me, those in gold will be quite happy. So it'll just be a magnitude of a great performance difference.
Yeah, I tend to agree. I've always looked at this complex as gold is your leader, and it will lead the way up, it will lead the way down, and once the trend is established, others will follow, right? So that's exactly what happened here. I mean, gold, if you look from 1,050 gold, which I think the low point after the pullback, and 1383 silver about the same time was the low point there. Right now, gold is up probably about 40%. Silver is up about 20%. It took gold to get up about 20% for silver to start moving, okay? And I always think back to Bernard Baruch, and I'm gonna screw up this paraphrasing of his statement, but he said, I don't care about the first 20% of profits on investment. I don't care about the last 20% of profits on investment. I just want my 60% in the middle, right? So, I mean, there's a lot of wisdom in that. You don't go chasing every, windmill like Don Quixote. You wait for the trend to establish. That's usually about a 20% move. Then you go ahead and make your investment, and you don't stick around hanging on for dear life at the end of the tail end of the rally. You go ahead and take your profits and move on. Okay, a lot of wisdom there. It's exactly what's happening here, and I think both of them now are firmly into bull territory in this leg up. So the reason that I think we all believe this is happening, I don't believe it, I'm certain of it as I'm sitting here talking to you, is, the mismanagement of fiat globally. And I know this is a topic that Brien wants to sink his teeth into, and I agree with him. I think it's important. The reason that real assets like gold, silver, real estate, what have you, are going up in price is because of the falling or the devaluation or the weakening or the diluting of the currencies with which we measure them. What are your thoughts here, Brien? I look at a 25% or a 20, I guess a 0.25 rate cut, and I'm thinking, really, is that enough to make this happen? But of course, that's just the tip of the iceberg of where things are going, and it's just a small, I guess, indication of the state of things. What are your thoughts on fiat, debt, everything else?
Well, I have a lot of thoughts, but you mentioned that quarter-point rate cut. I mean, it's amazing to me the world we live in right now. The New York Fed president, John Williams, was interviewed, I guess a few weeks ago now. And before, when they were just talking about the possibility of a quarter point or even a half point rate cut at the Fed's July meeting. And they were interviewing him and about the possibility of a rate cut. And he just reeled off a litany of reasons against why there should not be a rate cut. Starting to get wage growth, low unemployment, the economy's on trend. We're very close to zero bound on interest rates. And he comes up with just all these reasons why there should not be a rate cut. And then his conclusion is, so I really think we should cut by 50 basis points. And I couldn't believe he said that. It was like 2 + 2 = 6 all of a sudden. And it was just a bizarro world. And I don't understand it. It doesn't work. It didn't work for Japan. They're in a trick box, so they're just going more and more. And it kind of gets back to what I was saying, that the patient now needs a greater dosage of the medicine to deliver the same effect. Sooner or later, there's going to be no effect. And at that point, I think the fiat currencies, the dollar foremost among them, because it is the world's reserve currency, is going to lose any credibility. And the Fed will lower rates until it loses control. And at some point, it's going to lose control, and rates are going to head in the other direction. And that's the real dangerous outcome that that could come from all of this.
Gotcha. What about you, Chris? Is it the mismanagement? Is it the negative real interest rates? Is it something else? Is it the fact that we're the world's reserve currency, and people have been buying our debt and financing, let's face it, our higher standard of living here in the U.S. for a long time now, and they're no longer interested in doing that. They're looking for alternatives to the dollar. Could it be something along those lines that takes this even further?
Sure. So I would say a couple things. I mean, just on the basic, all fiat currencies eventually fail. It's hard I know many people here in the U.S. can't get their head around that, right? There's this normalcy bias that no, the U.S. dollar is here forever. Those sorts of collapses or losses couldn't happen here. It will happen here. It is happening here. Basically, we became a centrally managed economy that everything is just about the Fed and rates. I mean, I remember when I came out and started working in the 80s, at least you could read the Wall Street Journal, really read more about companies doing things and putting out products. All we hear about every single day, nonstop, the Fed, the Fed, the Fed. I mean, this is all our economy is. What's the Fed's interest rates? If we don't cut 50%, we're all going to be in a depression. 50 basis points are going to save us. I mean, I think what Brien Lundin said, it's insane. This is a centrally managed economy, and like all centrally managed economies, especially ones where there's no free market, where you have entities that should have been allowed to go bust in 2008, who are going to be bailed out because it's about saving their hide. It's not about what's good for the economy or keeping the dollar strong for a little bit longer. So whether it's communism and centrally managing an economy or centrally managing a currency and having agendas and protecting certain groups at the expense of others, that means it's all going to fail. And that's exactly what's happening now. We're completely in a trap. It can't be fixed. There's no will to fix it. I actually think if you use the analogy of a disease, we have cancer as a monetary, our economy, our financial system, that was like stage 1 maybe 20 years ago. But now we progressed to the point it can't be cured. You waited too late. Even if someone had all the answers politically, socially, you could never implement them. So with that being said, I think people are wasting their time if they give any thought to thinking it's going to be repaired, that things like the protection offered by precious metals may not be needed. I have to say, you can't prove, I haven't seen anyone give me a credible argument that this system isn't going down.
Yeah, it's no different than any other failed world dominant currency. I'm sure they said the same things in Britain, Spain, Italy. It'll never go away. It does, because politicians basically spend more than they take in order to feed special interests that are going to get them reelected. It's job security. It's so plain and simple in human nature. Brien, you were talking about the crazy moment where they, what'd you say, 2 + 2 is 6 or something like that.
Mm-hmm.
I think back to at your New Orleans investment conference when you had Alan Greenspan on the panel. And, two things came out of that interview when you had him up there. I think it was with Porter and trying to think who else was up there, but
Mark Faber.
Yes, exactly. Two things stuck with me from that interview. We sat in the front row. I want to hear every word. The first thing was when he talked about, all these brilliant economists at the Fed and they're truly remarkable people, and they understand this, that, and the other. But he said the bottom line is they have no idea what to do from here because we've never been here before. That was one thing. The other thing that really stuck out to me was where somebody asked him, well, if you're such a disciple of Ayn Rand, why on earth did you do what you did when you were the chairman? Why did you let this happen? And his answer brings chills to me to this day. He said, you act like I had a choice.
Mm-hmm.
So,
No, exactly. His view was that it was not his job to disallow the government from funding itself. It was the government created the debts, and it was the Federal Reserve's job to pay for those debts, to float the paper. And yet, you know, I asked him about those debts in a private conversation, and you know, asking about how big, or talking about how big and unmanageable the federal debt had grown. And he said that that's not even the worst, or the worst danger, or the biggest issue. He said that after 2008 with Dodd-Frank, that the U.S. has effectively backstopped all of the too big to fail institutions. And he said that the derivative books of those too big to fail institutions dwarfed by a large magnitude the federal debts and even liabilities. And if you look at the nominal exposure on those, it goes past $1 trillion, and you start getting into that number quadrillion. And you know, people say, and rightly so, that is the, you know, that's the nominal risk involved, and it's not the bottom line risk involved. But still, it's a bunch of dominoes, and if one institution falls, the dominoes are going to fall. And that issue was one that people don't really talk about, but that's the one that Greenspan told me was the biggest danger of all. The total for those derivatives are actually incalculable, because the institutions themselves don't have a good handle on what they are.
on that comforting note, I want to switch to an area where I know you are very, very comfortable, and that's the resource or the mining sector. We're seeing some good things there. I know last week when we were talking briefly, you were talking about the financings and so forth that you're seeing.
Mm-hmm.
How should we expect this breakout in gold and silver, and I would assume other metals, commodities, real assets to follow? How is that going to play out for the mining sector? What are your thoughts there?
Well, I think very well, and it's just starting, but just to put things in perspective, you know, we're talking about physical metals on one end of the spectrum, and it's a very wide spectrum, because if you're looking at physical metals as insurance, safeguarding your wealth against the inevitable devaluation of currencies, and that's about the most rock solid conservative thing you could imagine in the financial arena. On the other end, you get into mining stocks, and in my area in particular, junior mining stocks. And that's way on the other end of the spectrum. That's past investment. That's
not wealth insurance?
No, not at all. Not at all. It's past investment into speculation. So that's kind of the area that I delve in. And like we said, the big miners, the mining indices, the gold producers have already started to moved really right along with gold, confirmed the move, and offered strong leverage to it. Right now, we're getting to the point where these junior mining stocks are just starting to move. It's right on that pivot point. They have risen a bit in price, but the investors in Vancouver and Toronto still had a lot of well-earned skepticism about it, and a lot of cynicism, and didn't really believe it. But now you're starting to see companies, junior companies, come out with announcements of financings, and then they have to upsize those financings. So people are starting to put money into the sector. Prices are just starting to respond, in other words. And this is a crucial point for people who want to or are actively involved in this sector, in that we have a major gold move confirmed. So we have that risk out of the way. And in fact, it's now an opportunity. So the move in gold is confirmed, yet the junior mining stocks have yet to really move. You know, maybe only 10, 15% for a lot of these really well-positioned companies. So there's huge opportunity there, and a lot of bargains still on the table. So it's an opportunity, it's a window of opportunity that I think is going to start closing as far as bargains being out there. But these, as you know, in a secular, long-standing bull market that lasts 3, 4, 5 years, these stocks can go up many times over, 3, 4, 5 times. The last bull run, we had a lot of picks in Gold Newsletter that went up 10, 20, 30, even 40 times over in value. And that's the kind of gains you're going to see from the biggest winners in this sector as we go forward and as gold and silver keep advancing.
And you know, it was a real bloodbath. There's no question, right? When it came down, I mean, how big was the drop in the overall sector? I mean, it was
well,
massive.
a lot of these, as far as you can get, a lot of these companies no longer exist. In fact, a lot of the companies from back in 2007, 2008, even 2011 are no longer being run, or they had rollbacks where they're worth 1/10 of where they were before. So they're coming back from a long way down. But even the big mining stocks, if you look at the major mining stock indices, they're trading right now at about 1/4 the levels that they were just in 2011. So the median mining stock, the median or the average mining stock out there, if we get back to the 2011 levels, is going to quadruple in value. So you can imagine what the better producers will do, or what the much more leveraged junior mining stocks will do. And that's the scope of the opportunity we're looking at here. And again, from the speculative end of that spectrum.
Gotcha. Any thoughts to add, Chris? I know we're talking with the guru here in this regard, but
Yeah, I will defer to Brian when it comes to mining. I mean, I could put my 2 cents in, but I don't think it'll be and that much incremental value.
well, I'm going to come right back to you in a second. My only thought here, and I'm a firm believer in diversity. I know you are as well, Chris and Brian. I think people get this confused a lot. You know, I can't tell you how many calls I've taken where, you know, somebody subscribes to a newsletter, they tell them to put 5 or 10% of their net worth or investable assets or whatever it is into precious metals, and they say, I'm already covered. I own Newmont Mining, right? And the point I try to make every time I give a presentation or have a workshop or something is, it's not the same thing. Okay, now don't take this the wrong way. It's not that I'm not a believer in resource stocks or mining stocks. I think they're wonderful and they're great opportunities, especially if you find the value, right? But it's not a precious metals allocation, in my opinion. It comes out of an equities allocation. The 5, 10% or whatever that number is, where you build your wealth insurance. That's physical gold. That's physical silver. That's not mining stocks. It's as Brian said, it's the opposite end of the spectrum of wealth insurance. It is worth having. I have it in my portfolios. The bottom line is, it's just understand which basket it goes into is my thought.
Yeah, Rich, just to add on to that a little bit, diversification is key, not only in the precious metals arena. You should not only have mining stocks, and you should not only have physical metals, but you need to diversify, as you say, in each of those baskets. In physical metals, you should have allocations to gold, silver, the PGMs. You should have it in different forms. You can have a paper representation that offers liquidity, but you should always have some physical metals. You could have physical metals in storage in the country, out of the country. You should have some readily available, readily accessible, not in a bank safe deposit box. So within each of these areas, you need to spread things around. And the way to do that, you need to educate yourself in this area. I tell people all the time, don't buy my newsletter and start buying these junior mining stocks. Take the time to study up on the area, download our reports, go to investment conferences, talk to companies, talk to the other newsletter writers out there, spend the money, spend the time to learn the sector, and invest as you go along, and fine tune your allocations as things go along. But you do need to dedicate some time, effort, and money to educating yourself.
100% agree. So I told you, Chris, I was coming right back to you. If it's okay with you, I'm going to put you first up on the spot here. Given everything we've talked about, What's your thought on where the smart or prudent money is going right now?
In the, just in the precious metal space or overall?
In general, and it can include the precious metal space. I'm guessing it might.
Well, so stock market, it could go a lot higher, right? I mean, based on what they're going to do, reliquify the market. There's a talk about they're going to have to do QE again. But to me, the equities market, excluding the miners, I'm talking about the general stock market, it's pretty much, it's so overvalued. It doesn't have this store of wealth, and I don't think it can perform as a good store of wealth versus the precious metals going forward. Some people you'll hear, I don't know if you hear this, they will lump in real estate as a hard asset, a tangible asset. I think in these times, that is a very risky asset. Problem with real estate is, what are the things that are beautiful about precious metals that real estate lacks? Portability, divisibility, right? You buy $1 million in precious metals and sell it off $1,000 at a clip, or even less with your silver. Real estate, if you're probably buying rental properties, and then you're dependent on viable renters. Well, as the economy contracts and people's wages don't go up, but the cost of carrying real estate through taxes and insurance continues to rise, are you going to be able to get, blood from a stone? So, just look at markets like New York City commercial. It's a horrendous market. So I think the idea that you're going to go to the safety of real estate as a hard asset is off the table. So to me, the universe of what's available for money to go, and we know there's a tremendous amount of cash looking for places to go, which is why so much gets thrown into things like cannabis stocks and other tech ventures, because it's really just places looking to go. So I think, where's the money going? I think for most investors, they're a little bit lost. Even some pretty savvy investors who have a lot of money, they don't know where to go. But we are seeing the precious metals perking up. We are seeing attention to the metals. We're also seeing, even in the mainstream financial media, talk about the precious metals that we have not heard for 5 years. And instead of disparaging it or talking down to it, we're talking about how they're coming into play again. I think that dovetails into everything we said. We are in the next big leg up, where now even the mainstream financial media is starting to talk about the viability and the logic of precious metals.
So it's no longer a 4-letter word.
Yeah. And we know there's some high-profile fund, hedge fund folks and all that who are taking positions. So again, I could speak to what goes on in the equities and fixed income markets. I think fixed income is a really risky market, just on how many of these companies are in the years to come are going to default on debt, and they may not be able to get bailed out. As Brien said before, the medicine is having less and less of an effect. The Fed juicing the market, to keep it blunt, is having less and less of an effect. And at some point, it all starts unraveling. And I think we're actually in the early stages of that right now. I think when people look back, they will realize that the wheels really came off the bus, as they say. It's already happened. And now it's slowly playing out. So, I don't want to lead and come as expert, and pick any other categories. I will just make the case why there should be a reasonable and enough of a position in precious metals within a portfolio to be meaningful. So I won't use numbers, and I hate to digress, but we talked about how much should be in the metals. It's not my job to tell people what to do, right? There's the pat answers of what percentage, and I would just say, personally, it at least has to be meaningful, that it could be conducive and going to help your overall portfolio out when the other categories start to go south, right? Gotcha. So having 2% in precious metals may be nice, but if 98% goes crashing down, there's only so much 2% can do.
What about you, Brien? Same question there. Where do you think money is going to be treated best here going forward?
Well, I think money is going to be treated very well in gold and gold-related investments. I think a lot of money right now is going, and Chris alluded to this, is going into the bond market. And it's ludicrous, and it's seemingly ludicrous. And they're on Twitter today, somebody was commenting that there are actually adults buying 100-year bonds yielding less than 1%. And my response to that was that they're not buying the yield, they're buying the trend. And the entire bond market around the world today is built upon the foundation of the greater fool theory. They're just buying it because they think somebody else is going to pay more for it down the road. Now, and for precious metals, that's going to help us out because the trend is established and we're going to get more of these trend following investors. But the good thing about precious metals is that there's a fundamental foundation there, that as all of this liquidity ramps up yet again in another cycle, it has to be executed to a far greater degree than before. And remember, the last one broke all records and was unprecedented with introducing quantitative easing and negative interest rates. So we're already starting to break those records now, and we're going to break those records in terms of quantitative easing when that comes back into play. So these fundamental factors are what are going to support precious metals going forward. It's not going to be just a greater fool theory, people buying today because somebody is going to pay more down the road, but there will be trend following. And when the rest of the world comes into this tiny little market with these vast oceans of liquidity, it's going to be explosive to the upside in terms of price response.
So, and all good points. Go ahead, Chris.
I just want to say one thing, and it may even seem a little sarcastic toward the Fed and such, but when they talk about the Fed is in uncharted waters, right? They're facing things. I don't think people realize how bad that means. That means they mismanage things so bad that it hasn't been this distorted in all of recorded history. That's what it means, and that's not a good thing, right? You don't want to be placing your bets with someone who's gotten themselves in such a predicament that in all the years of history, no one's gotten it this messed up, and actually have faith that those people are going to be going to unwind it. So, this is an unprecedented thing. Now, the one thing beautiful about the precious metals, for 5,000 years, it's always worked.
You just took what I was going to say out of my mouth, Chris. I'm right there with you, and that's where I was going to go. I don't want to just be a homer here and say, we're precious metals folks. You ought to buy precious metals. Yeah. I mean, if there's a trend clearly established, my God, why would you turn it away from it? And I will give a little bit of numbers. I won't tell people what they need to do. That's up to each individual, their situation, their tolerance, etc. But what I've followed is I'm always an owner of 10% in precious metals, primarily gold. Okay, with a little bit of junk silver for divisibility. That's my wealth insurance. On top of that, when you see trends like this established, I think you can own some precious metals for profit as well. And I ramp it up another 10, 15% in this type of environment. No more than that. And some people would say I'm crazy for going that high, but it's really just for a fairly short period of time, to be honest with you. The 10% is what I hold on to always. I don't touch that unless I have a financial crisis that I need to sell it to deal with. And if I do, I sell it immediately. I don't blink an eye. I don't think twice. That's what it's there for. The for-profit extra 10 to 15% in times like these, that I rebalance. So if I put another 10, 15% in precious metals and it doubles, I'm selling half of it. Okay, I don't even think twice about that either. It's unemotional. So that's where I'm at. I will suggest two other things. One, your product. We talked a lot about diversity here tonight within the sector, within the complex, etc. I don't know of a better product out there to deal with that diversity in the precious metals complex and the PMC ounce. If you guys listening don't know about this product, haven't taken advantage of this product, I think you need to email us, call us, and find out about it. It is worth knowing. It's worth owning. It's instant diversification. We don't have the time tonight to get into the PGMs and platinum and palladium here, but palladium was leading the way for a number of years as gold languished, trying to get consolidated and break through 1350. Palladium was your shining star in the precious metals complex, but it's at a point now where it's probably going to be handing off the baton to gold, silver, and don't look now, platinum. So owning all four metals makes sense. The PMC ounce ought to be in your portfolio, and you should be blowing up our phones tomorrow asking about it. The other recommendation I'm going to make is, I've been to the New Orleans Investment Conference for I don't know how many years at this point. My uncle Michael, who started this firm, has been there since the very first one. When they were drawing 5,000 to 10,000 attendees. Is that right, Brian? In the 70s?
Yeah, back in 1974. It peaked in 1980 at about 4,500 attendees.
If you're not attending this conference, I think you are missing out on a ton of information. And when we send out the follow-ups to the webinar, I'll be sure to have that link in there so you guys can register and attend. It's one of those you really don't want to miss. It's the granddaddy of all investment conferences. When you have people like Thatcher and Greenspan, and my God, the list goes on. I can't even remember all the people you've had there that are worth listening to include Brian and his team. So those are my two recommendations. Precious metals, specifically the PMC ounce. And you need to attend this conference. I believe it's the first few days of November this year. Is that right?
That's right, November 1st through the 4th. And just real quickly, they can get more information at neworleansconference.com. And if they go to goldnewsletter.com/webinar, they can save up to $400 on admission to the conference and get Gold Newsletter at half price just for the participants in this webinar.
Fantastic. Thank you for doing that, Brian. I'm going to shift gears now to the Q&A portion. We've got a number of questions that were sent in ahead of time. We've already answered one, I hope, to our attendees' satisfaction about, is this one believable and for real? I think we've covered that ground. That was sent in by several folks, by the way. It was a topic on everybody's mind. I have one question I'll deal with right off the top here. It was, and I'm pretty sure it was at your investment conference, Brian. I was on a precious metals panel where she's alluding here. But Margaret in Florida basically asked, I heard you speak some years ago when you were in a video panel at a conference with CEOs of mining companies and similar. Brian was there as well. Basically, you made a statement the government has no record of gold pit purchases if you pay with cash. She said the moment was electric and panelists and attendees cried out, what? But she wanted to get some clarification on that. And, I don't know the context. I can't remember which conference it was, but I will tell you this, that, precious metals transactions typically are not reportable. When you make the purchase, they're typically not reportable. And I'm throwing in typically now because something happened here recently that's changed. As a result of South Dakota versus Wayfair, all these broke states who have mismanaged their state coffers and can't afford to pay for all the things they've agreed to pay for, they have jumped on the bandwagon and have started assessing sales tax on precious metals. So, and it's a mess, I'd be quite honest with you, depending on what state you live in some cases, what county, you get taxed at a different rate. The precious metals dealers, when they hit certain thresholds, have to collect those taxes from you. So in some cases now it will be, I don't know if it's reported, but it will be taxed. And we'll have to keep records of those things. But the bottom line is it's not illegal to own precious metals. It's not typically a reportable asset. There are certain circumstances when you sell it back where you do trigger reporting by the dealer. But when you sell it back, whether you make a profit or a loss, you're supposed to report that even if it's just 1 ounce of silver. Be honest with you. And I don't know about you, but I don't look good in the Dayglow jumpsuit. So I'm going to do whatever I need to do. And they still aren't taking 100% of the profits just yet. So I don't know if anybody else wants to weigh in on that. I think that's a good enough answer there. Move on to the next question.
Rich, I just want to chime in on one thing, only because there are certain states that tax bullion transactions, right, which you just talked to. And the old days where as long as you bought it from a dealer out of state, you were exempt, that's gone. So if you're in a state like New Mexico, New Jersey, that collects sales tax, and it's delivered to those states, you're going to have to pay the tax, and the dealer's going to have to collect it. Now, one thing is it's all about where the metals are delivered. This also makes a case, especially for people in those states, if they store it in a depository in a state like Delaware, right? Because the delivery location is tax exempt. So something to consider for folks in the states that are impacted by tax.
Gotcha. And I'll add one other thing to that. It's not even that simple. If you guys have questions as attendees and listeners, you need to give a call, send us an email, and clarify. It's even deeper, I'm finding out, as we dig into the legislation in various states. In some states, if you purchase and take delivery in a non-taxable state, there's no sales tax at that point. If you eventually, say 10, 15 years down the road, take delivery, from there, sales tax is due.
That's correct. Because,
and in some states, and it varies again by states, you're still responsible for the tax even if it's not delivered in your state. They have an interpretation of that. Complex as heck, and you need some guidance. So reach out and ask those questions, and hopefully we can either answer them or find the answers for you. It's not something you want to take a shot and hope it works out. Okay. Moving on, it says gold and silver grabbing the headlines right now. What are your thoughts going forward on platinum and palladium? Is it time for a resurgence in platinum? That comes from Joe in Utah. Anybody want to field that one?
I think that platinum's a great play right now. It historically has traded at a premium to gold. I don't know that it's going to do that, but it's been lagging behind. And for that reason only, I think at some point it's going to join the party, and it has some catching up to do. So at these levels, I think platinum's very attractive.
And just a caveat, we've got an anonymous attendee that threw in, why do you think palladium has been dropping recently?
I have to admit, I didn't call the bull market in palladium. Frankly, I don't know anyone who did. So I don't know if I can comment on why it's dropped, other than the fact that it has risen so far. It's a fairly narrowly traded market. So it obviously got overblown a bit to the upside, and it's correcting some of that on the downside.
Gotcha. Any thoughts, Chris?
Yeah. So palladium and platinum are, really industrial metals, especially palladium, right? There's a little bit of platinum jewelry. The dynamics behind them are different than silver, which is even quasi, monetary and industrial. I mean, you have geopolitical issues, right? They're basically only coming out of 3 countries or 2 countries, Russia and South Africa. There's concern about supply from people who actually use it, like the automobile manufacturers. So, they're worried about supply and they'll buy it up. The inventories of palladium are being burned down. What's being consumed by industry is greater than what comes out of the mines. And those mines, again, Russia, South Africa. South Africa is really an economic basket case. You can't really count on them. Russia, we have geopolitical issues. You don't know where that's going to go. And you think about it, even at these prices, about the amount of palladium going into a car via the catalytic converter, it's only about $150, right? It's not a lot. So as an automobile manufacturer, do you really want to get caught short? So they're buying it. They're building inventories, which is driving the price. Now, as far as platinum coming back, they're substitutes for each other. They can both be used in a catalytic converter. Used to be all all platinum in gas and diesel engines. Now palladium took the market share in gas engines. Diesel is still platinum. But now with this price disparity, right, this huge gap, one in the 800s, one 1400 and change, you may see a move back to platinum. But you don't know when this market timing is going to happen, right? I mean, I'll just go back. You mentioned the PMC ounce. There is a weighted amount of platinum and palladium in the PMC ounce. We never know when a metal's going to hit its stride. I know some people in this industry who have been analysts in precious metals for 40 plus years, who got platinum early, but sold out when it hit 1,000 because they said, well, there's no way it's going over 1,000. Well, that was 400 and something points ago. So my point is the PMC ounce, again, just because you brought it up, is a easy turnkey way to own a physical precious metals product that's weighted logically between gold, silver, platinum, palladium. Palladium really did a lot for the PMC ounce these last few years, helped it continue to outperform, especially on a risk-adjusted basis, gold and silver. And that's only 1.75% of the weighting is palladium. So it's not like there was an oversized position. Now that gold and silver are starting to contribute, now that the PMC ounce is benefiting even more from them, but it's a good chance platinum's going to be a big contributor too. And to your listener's question, logically, it'll probably catch up and start getting utilized more in the world of industry, which is going to buoy its price.
Yeah, I think I'll just add two quick points. One, you mentioned Russia and the, who knows what's going to happen. I remember when palladium, prior to this move, hit its all-time high as, I think it was 1,075 an ounce. And they made that move up from about 140 bucks an ounce. And it did it in about a year. That's a big move. The reason it happened is because Russia was the primary producer. And they decided for about a year not to ship any palladium to market. They cited bureaucratic issues over quotas and everything else, but basically they just decided not to sell. And as a result, I think there was some credibility to this that Ford Motor Company almost went out of business. It's not like you can just flip a switch and say, today we're going to deal with palladium, tomorrow we'll work with platinum. You got to retool everything. Okay, so they got caught basically shifting all their gears over to palladium as substitution, and they got caught holding the bag. Now they're paying 1,075 an ounce. And then once Russia started shipping within a year, price was back to 140. Okay, so you never know what's going to happen. The diversity makes sense, and I do think it's possible to see some substitution creeping in, but it won't be by the flip of a switch, as I said. Any other thoughts on that, Brian, before we move on to the next question? Because I'm coming up your alley here.
Okay. No, I think we covered that well.
So I've got two questions kind of geared toward you, Brian. Tom asks, what streaming company is the best value? And then I'll follow that up. Tim's got a question for you regarding the derivatives market.
Streaming company, I like Metalla Royalty. I'm drawing a blank on the symbol right now, but it's METALLA, Metalla Royalty. It's a smaller royalty company than the other ones, so it hasn't quite gotten on everyone's radar screens. It's not small by any means. I believe the market cap is around 180 million or so, but these royalty companies don't typically get the market's attention or demand to be in larger portfolios until they get a market cap of around 250 million. At that point, they start to enjoy the kinds of multiples that royalty companies do. And that's the real attraction of royalty companies, is that they have a higher multiple because there's less, really almost zero operational risk. They don't have to run a mine, they don't take the metal, they sell it at a discount, and they enjoy a hefty profit margin.
No environmental issues, no permitting issues, no indigenous personnel issues. I mean, they got a lot of stuff they don't have to worry about. Exactly.
And for Metalla in particular, it's come a long way, up about 40%, I think, so far this year. But I think it has in addition to its royalty portfolio and its growth there, because it focuses on a smaller segment of the mining market that kind of the larger players overlook. Aside from that growth curve, at some point it's going to enjoy a higher multiple that the larger companies do as it gets above that, say, $250 million market cap level.
Gotcha. And then the follow-on question, not really related. So it says, Mr. Lundin, this is from Tim. I'm well aware of the size of the derivatives markets. It's my belief that the equity markets can't fall below a certain percentage point to keep the derivatives markets from being triggered, make them turn valid.
I'm not exactly sure what he's talking about there, whether he says it cannot fall is he saying they can't fall below a certain point before triggering these derivatives? I would agree with that.
I think that's what he's saying. If the
Yeah.
stock market pulls back a certain percentage, it's going to trigger the derivatives issues.
Yes, and not necessarily because of the equity markets, but of perhaps from the the repercussions of such a thing that's going to affect the bond markets. That's where you have a lot of these interest rate sensitive instruments. So it's going to have a fallout effect across all the markets. In particular, one of the things you'll see if there is a severe downdraft in the equity markets, you're going to see the Fed come in very quickly to liquefy the markets, to lower rates, to even go to quantitative easing again, because this is the house of cards they built. They designed the equity markets that we have today. Their whole goal through quantitative easing and zero interest rate policies was to create a wealth effect. So they built this, and they're responsible for it. And Wall Street is really, or the Fed is at the beck and call, not of President Trump, but of Wall Street at this point.
Brian, I remember when Ben Bernanke came out with his, it was in the Q&A following one of the Fed open market committee meetings. And, he basically, I don't know if he meant to, if he realized what he was doing, but he was very, very transparent and honest about what they were going to do here. And he said, basically, the economy's stumbling. This is after the crisis. And he said that what we need to do is we need to get people feeling that they're wealthy again. And I'm paraphrasing. Whether that be through the increase in value of their stock portfolio or the increased value of their home, we need to get them to the point where they feel, not are, but feel like they're wealthy, so that they can start spending money. Right. And that can go into companies, and they can start hiring and doing this, that, and the other. He didn't care about being sound. He wanted them to feel pretty good and start spending.
Absolutely. And the whole goal there is to get them to consume, to spend, to buy, to go out and not save. So the economy today is not built on saving and capital formation and investment and productivity. It's built upon spending and building that aggregate demand that the elitist economists feel is the key to economic growth. Aggregate demand, of course, can come from people spending or the government spending. And in fact, they look upon the government as the spender of last resort to rescue the economy. Whether that creates wealth, productivity or not, whether it's just moving a pile of sand from one place to another, as long as it's creating, as it's putting out paychecks and having people feel like they're wealthy and consuming, that's the adrenaline shot upon which this whole economy is based today.
All right. Anything to add, Chris?
No, I think it actually just, we talked earlier before, especially about, remember how people are selling because now the price of gold is up, and, when gold had gone down, now it's up and they're bailing out at probably exact wrong time, because unfortunately psychology is really one of the biggest drivers of why people buy and sell. It's not really the fundamentals. And what you just said is another example of it. The Fed, we just have to make people think they're wealthy, not really be sound or, be in a good financial position, but as long as they think it, which is just a psychology. That's the most important thing. But the people that really make the big money are the ones that are not susceptible to those sort of, we'll call it mind games, right? And make decisions based on history and logic and reality. Sometimes it takes a while for your decision to pan out, but it will if you do the right thing.
All right, I got another question from another anonymous attendee. What SR miner has best potential?
I think they're referring to a senior mining company.
Yeah, I think so too, as opposed to, it's not South African, et cetera. I think senior miner.
Yeah, it would be a senior or a large producer. I used to be very bearish on Barrick Gold for many years, but Mark Bristow took that over in the merger with Rand Gold, And Mark, I've known for decades. Jim Blanchard, in fact, helped him start Randgold in the early 90s. So was one of the early investors in that. And he's just a phenomenal manager of mining companies and builder of mining companies. So I think he's going to do a very good job with Barrick. Agnico Eagle has always been a very aggressive company that I like. But to be quite frank, I focus a lot more on the junior end of the spectrum. So I wouldn't be the best person to comment on the senior miners, except for those kind of broad brushed views that I just expressed.
I've got a question for you, Brien. You know, I think one of the things that opened the gates on the last bull run, 2001, 2011, was, you know, I think it was Newmont took the lead. They de-hedged. So basically they no longer wanted to sell today's production or tomorrow's production at today's prices, right? They said, I'm going to go ahead and I'm going to wait and I'm going to get today's prices for today's production because that's obviously a bullish signal that they believe higher prices are coming. Where do we stand now in the complex? Are we de-hedged? Are we on the fence? Or are we still hedged?
Yeah, that was a big issue in the 1990s and going into the early stages of the 2000s, and that big bull market is when are companies fully exposed to the gold price. And what happened was that the big miners would sell forward their production, collecting the prices today, and they did that to basically protect their jobs, to lose the exposure to the gold price, make sure that they were firmly ensconced in their executive suites. And at that point, it became little more than industrial companies, industrial plays. So we never recommended companies that did that, or especially to any significant degree. Barrick was one of those companies. Interestingly, in the process of all of that, the Gold Bugs Index of unhedged miners, which is the symbol is HUI, was created. And this index tracks those companies that do not hedge and are fully exposed to the gold price. It's not as widely followed these days as the GDX or the GDXJ, because most of the companies today are not hedged. But I predict that as this gold price continues to advance, you're going to see some of these companies start to hedge their production. They'll claim it initially because they need to get some money to fund growth or whatever, but they're going to lose some of their exposure to gold in the process. And I think that gold investors who are looking for that leverage need to avoid those companies and really look to the Gold Bugs Index to track the companies that are not hedged to the price of gold.
Gotcha. I'm going to shift gears a little bit here. Next couple questions kind of deal with the currency reset issue, if you will. So one listener says, everybody's been calling for the collapse of the dollar for as long as I can remember. Why hasn't it collapsed, and why should I think it will now? And that's followed up with, you spoke about a currency reset. What does that look like? I think they're kind of related.
I can speak to the fact, I totally understand people have talked about this sort of thing forever, especially in regards to the debt problem. You know, I've been involved in the New Orleans Investment Conference, which, you know, is the preeminent conference in the hard money industry, really the preeminent retail investment conference out there. And I've been involved with it for well over 3 decades now. And I can't tell you the parade of really smart people that have come across our stage and predicted over and over again that this debt bomb is going to blow up. So I look at this issue, I approach it with a large degree of cynicism. But I've run the numbers, I've looked at the numbers, I've looked at the impact. I'm the only one I know of that is calculated and tracked the effective rate of interest that the U.S. is now paying on the national debt. And I can tell you that now I've become converted, as it were. I'm convinced that within the next few years, this is going to reach a critical turning point, a point of no return. At some point within the next few years, we're going to be paying close to $1 trillion just in interest costs. I don't think the public is going to accept that. I don't think they're going to accept paying $1 trillion to these fat cat investors who bought these treasury bills and bonds, and especially to China, which owns a lot of them. There, if you think there's an outcry now for free college, for free healthcare, for free everything, just wait till you hear the outcry when we're sending $1 trillion overseas before you pay for anything at home, from defense to welfare to Medicare or any other entitlement. So at that point, I think people are going to start talking about, why are we paying this? Why are we saddling our kids with this debt burden that they didn't create? And it's a fair argument, to be quite honest. But you're going to see an outcry, and people are going to start talking about, why are we paying this? Let's not pay this. We can simply just default on these debts. And that's when I think you'll get a turning point in the markets, and the beginnings of a crisis in the dollar. And that's when gold is really going to soar, because the dollar is going to start cratering in an event like that. So I think that, yes, why now? Because we've gotten to that point where it's a near mathematical certainty within the next few years that it can't advance any longer or any further.
Hey, Chris, I'll kick it over to you for the second part of that. We get a reset. What does that look like? I mean, I think we've had resets in history, have we not? And they all look a little different. What does the next one look like?
You know, the reset can take a lot of different forms. You know, some people see a new currency, a substitute currency. Some see a global currency that's just kind of used on, we'll say, commercial transactions, right? But everyone still keeps their local currency, like the dollar, and that just devalues tremendously versus that. You can go as far as saying, well, the U.S. Treasury will just start issuing directly Treasury, the money directly, like the Constitution says, and it won't be the Federal Reserve. So I don't think any of us can speculate what a currency reset is exactly going to look like, how it's going to be done. I think the safest bet is to understand, to what Brien just pointed out, the system that we've created is unsustainable. At some point, the US dollar will be devaluing. At some point, we will default on our debt. It will be an easier thing to do, or just debase the currency and pay those bondholders with basically worthless money. And I think that's the thing that investors just need to know. That's the trend we're going. And it doesn't mean that overnight the dollar just collapses and becomes zero. I don't think that's going to happen. I think it will just continue to devalue. It'll accelerate. And what a person just needs to do is position themselves for the devaluation of the dollar, and not be worried about exactly how that reset is going to materialize.
Yeah,
Positioned outside so that you're not affected negatively by that reset.
Gotcha. I've given this a lot of thought over the years, and because I've gone to those conferences, I've heard key people, I won't mention their names, get up there and say, I've been speaking for 40 years about the collapse of the dollar. It hasn't happened. He goes, I don't know why you're still coming here and listening to me. But at some point, logic has to kick in, and things have to act a little bit closer to rationally. I think the way it happens is not, this is not Zimbabwe, where all of a sudden we just add, a whole bunch of zeros at the end of the dollar. I think what happens is, and it kind of goes hand in hand with this whole movement toward, world and all this other stuff. I think it's a change in a change from dollar being the reserve currency to a basket of currencies and even potentially commodities that become the reserve currency. And I think that's the way we devalue the dollar palatably. Back in 1933, when they confiscated gold, that wasn't about taking your gold. That because the gold was tied to the dollar. So we scooped up all the gold, and then once they had it, they revalued the official price of gold and in effect devalued the dollar. That was a reset. Okay. I think in this case, it possibly happens with a basket of currency commodities, where you go from 100% of the dollar being reserve currency to now it can even be a majority part of the basket. It could be like 80, 85%, but that's a 15 to 20% devaluation of the dollar.
Yeah, and I would just say, 10 years ago, 15 years ago, we were all in this, and we were going to conferences and listening to very smart folks talking about the dollar being dethroned as the reserve currency of the world. But it's happening right now, right? We're seeing bilateral trade,
Yep.
seeing the development of systems in lieu of SWIFT. So it's not speculation anymore. And it takes a while to put all these mechanisms in place, but it's happening and it's not going to dial back, right? So now that they're creating some alternatives to SWIFT, we're not going to do anything that says, okay, we'll change our mind, SWIFT is better. Once these things get in motion, they stay in motion, they accelerate. And at the end of the day, as the dollar becomes a smaller and smaller part of global transactions, it will devalue. So, again, there could be a lot of different forms in the quote unquote, that's a big term to say currency reset. I think you just need to be, just go along with the fact that the dollar would devalue, position yourselves in a form of wealth, in a form of money that's going to counter that and come out of that and keep you whole.
Nobody manages gold. Nobody can mismanage it. Brien, a couple more questions. I think these two are tied. So the first one is, who's your favorite junior? Thoughts on MUX or BTG? And then follow up with a different attendee. Can you recommend some junior mining stocks? So I think the two of those kind of go hand in hand.
I can't remember. I'd have to look up what MUX and the other one are. One of the companies I like right now is Aftermath Silver. I think the symbol is AAG, and I think it is a -H on it because it's kind of being rejuvenated. It's an early stage silver play with some historic resources and 2 projects in Chile. I am an investor in that company, so I participated in a financing. And I actually have been an investor in that company for a number of years, back in the last cycle. But it's being rejuvenated. It's being widely watched by a lot of people, a lot of newsletter writers and the likes. I think it's going to have a high profile. The management team has some other successes behind it and is highly respected. So I like that play. Another company I like is Revival Gold. It has a couple of million ounces of resource in Idaho. Very good management team. They're looking to get the resource up to 3 million ounces and also to expand and acquire other projects, not necessarily in their area. Very aggressive management team. I do not own that company. Its symbol is RVG on the Vancouver Exchange.
Gotcha. And Brien, our listener came back in just to clarify. MUX is McEwen.
Yes, Rob McEwen's company. I really don't follow McEwen. He talked about it a bit at a conference, at the Sprott conference I was at last week, and he's a great guy. I think basically it's going to track the market. He's a well-known mining financier and manager. He built Goldcorp. And this is his next play. He also invested strongly in Great Bear Resources, which is another company that I own. That's a very high-profile discovery play right now and has the potential to become very large. But I have a strong hold on that one right now because we're up 16 times on that recommendation in Gold Newsletter right now. So I'm actually telling investors that they haven't already take their risk off the table and only proceed further with whatever they're comfortable with. It does have the potential to go up much further from here. McEwen certainly thinks so. But again, back to McEwen Mining, he likes that company, and I don't follow it that closely, but I think it will track the rest of the market in the juniors. Certainly, it won't underperform.
All right, and then he also clarified BTG is BT Gold. Any thoughts there? Or?
GT Gold?
BT. Boy
BT.
Tango. Yeah.
I don't follow that company. I really couldn't comment on it. Sorry.
All right. And if Brien doesn't, I can assure you I don't.
There's only a couple of thousand companies out there.
Yeah, that's all. I don't see at this point any other questions, but I got to tell you, it's my favorite part of these webinars, and we always think we'll have about 15, 20 minutes worth of Q&A, and here we go, another 45 minutes of Q&A. And he's saying, sorry, B2 Gold.
Yeah, that's another larger.
Thank you for the clarification.
Yeah, B2 is a larger producing company. I have not followed that company for about, maybe 20 years. So again, I apologize. I can't really speak on it in any great detail.
Well, kick it over to you, Chris. Final thoughts, parting shots.
No, I just, for those of us who are very invested and involved in these precious metals markets, you know, we spent a number of years, even though we have been in a bull market really since December 2016, it still didn't really feel like it for a lot of folks. Congratulations for those who hung in there. I think, you know, we're in for a really nice couple of years. Unfortunately, a lot of that means there's some crazy stuff happening in the world. So it's you take the good with the bad. But, you know, I appreciate the chance to come and speak with you guys. And for the people that come and view, and I just encourage them to you know, Brian's conference I've been to, it's a wonderful event, great time of the year to be in New Orleans also. And just reach out to either like Rich or I if you have any questions and you want us to elaborate and expand on some of the things we talked about tonight. And if you didn't have a chance to submit a question, just, you know, reach out to us. We love to talk with people and just talk about strategies and viewpoints and, you know, where you think things are going. So,
Hey, Brian, parting shots from you.
Well, yeah, just to reiterate what Chris said, you know, my friend Rick Rule is famous for saying in recent months, you've endured the pain, now stick around for the gain. And we've gone through years of a bear market in gold. I do think the market turned in December of 2015, but it has certainly not been a rocket shot rise since then.
I like that, actually.
Yeah, and we're getting that kind of a rise right now. So there's still an opportunity to profit. I think there's tremendous days ahead. Yes, investors should educate themselves, should come to New Orleans. I have a lot of free materials on my website that they can get, an investor's guide to investing in precious metals, investor's guide to gold and silver, rather. And if they go to goldnewsletter.com, they can get those free materials. If they go to goldnewsletter.com/webinar, they can get some deals on Gold Newsletter and the New Orleans Investment Conference.
And I recommend you take advantage of both of those. And Brian, I gotta say, on behalf of Chris and I both, thank you so much. You add a lot of information, knowledge, experience, wisdom for our listeners, and we really appreciate you taking the time with us here tonight. One last throw-in question here: how do I buy the PMC ounce? That's simple. Call us, email us. We can offer it to you, and I'd be happy to put it in your hands because I think I'm doing a credit service. So that might be recommendations. Buy the PMC ounce and start with an email or phone call ASI, and the TOIC, pick up the old newsletter, again, thanks, Chris. As always, love this dialogue, and we want to keep it going as long as possible. I think it offers something.
thanks, Rich.
And I'll leave y'all listeners with keep what's yours. And I think you have some ways to get that done. So.